Chapter 34, Money, Banking, and Financial Institutions. Important chapter that introduces the Fed, Federal Reserve System of the United States, very important part of our government. So first we look at the functions of money. This is important. Medium of exchange, obviously, used to buy goods and services. It is also a unit of account. It gives us a way to put a value on items. Of course, it's the dollar in the United States, yen in Japan, and so on. It's a way to measure our GDP. It also must hold some value to be a medium of exchange. This is what happens when inflation gets out of hand. The purchasing power of money goes down and it doesn't hold its value. Then nobody wants it anymore. Nobody wants to accept it as a medium of exchange. It is the most liquid asset. Liquidity is the ability to dispose of an asset quickly, and money is the most liquid asset. Of course, real estate would have to be sold before it is able to be traded. So we define the money supply by M1, which is the currency, the green stuff in coins, plus checkable deposits. Those are sometimes called demand deposits because you can get your money on demand, and it's obviously a very volatile, changing constantly part of M1 because people make transactions all the time using their checking accounts and debit cards and so on. Many institutions offer checking accounts, commercial banks, savings and loans, mutual savings banks, credit unions, and also some insurance companies. And we are seeing Google perhaps get into this business as well. M2 just adds another asset, near monies. Those are assets that have high liquidity, but maybe have some restrictions, like savings accounts. You can only take so much out per day or something like that. So they are more restrictive. Obviously, M2 is much, much, much larger than M1, and it changes hourly. You'd never have to know any of these amounts. What backs money in the U.S.? Trust. Government's ability to keep the value stable. And that's a job of the Fed, Federal Reserve. So it's based on trust. We don't have anything backing our money. I don't know of any country that does, except trust. It's issued by the government, and this is a very important test question. Why is it valuable? Because it's accepted. It is legal tender for all debts, public and private. That's what it says on the front of those Federal Reserve notes. And it's relatively scarce. It is kept relatively scarce. As long as it's kept relatively scarce, we have a responsible Federal Reserve, we don't have inflation, then it has more value because inflation erodes its value. Hyperinflation renders it unacceptable. So we want to keep inflation under control and stabilizing the money's purchasing power. This is obviously a subjective bullet point. Intelligent management of the money supply, monetary policy, appropriate fiscal policy. But we have a lot of argument as to what is intelligent management and appropriate policy. But currently, we apparently have a fairly responsible Fed. We don't have inflation, and they were not that responsible in the 70s when we had out of control inflation. It was called stagflation, high inflation, high unemployment. And fortunately, we've not had that since. So what is the makeup of the Fed? This is important. It is made up of 12 Federal Reserve banks around the country. And it's those are the bankers' banks. That's where the banks, local banks, get their currency, which at first is printed at the Bureau of Engraving in Washington, D.C. So there are 12 members of the Board of Governors. There are 12 members of the Federal Open Market Committee. The Board of Governors, there are 7, and then there are 5 presidents of Federal Reserve banks that serve on the total FOMC, Federal Open Market Committee. So there are 12 members there. Test question alert. The chair of the Fed, chair of the Board of Governors, is Jerome Powell, and he was appointed by Trump when the last one retired. So very, very important position. Federal Open Market Committee, there are only 12. So monetary policy is conducted by a fewer number of people than fiscal policy. So these are where the 12 Federal Reserve banks are. I highly encourage you to visit the one in Kansas City when all things calm down. And you can do so. It's very interesting. You get to see the plexiglass bins of millions and millions of dollars that go through the Kansas City Fed Bank. Again, the money is printed out in Washington, D.C. at the Bureau of Engraving. And on each one of those new notes, it has a letter A through L. That is the first place that money goes to, is one of the Federal Reserve banks before it's distributed out in the country. So Kansas City banks, very, very interesting. A museum of different kinds of money. And you can see that they read every piece of money that comes through there. Some of it is deemed unacceptable and it's shredded. They do find several counterfeit bills every day, and of course those are destroyed. So the Federal Open Market Committee aids the Board of Governors in setting monetary policy, and we will look at a later chapter, conducts open market operations. And all of these banks and thrifts, all of our banks and thrifts, 6,000 commercial banks, 8,500 thrifts like savings and loans, are members of the Federal Reserve. Now, you may see something else when you walk into the bank. Federal Deposit Insurance Corporation, member of FDIC. That is not part of the Fed. It was established in 1933 to insure deposits. That is its only function. Banks have to pay for that FDIC on their door, just like you have to pay for car insurance. So world's 12 largest financial institutions, this may be different today, but no surprise that the largest one is in China, and I'm sure that's still the case. So what does the Federal Reserve do? All of these functions could be done by other agencies, except for the last one, which is arguably the most important. Control the money supply. The next two chapters describe how the Federal Reserve does that. But the Federal Reserve was established in 1913, known as the Fed, and it was to be a lender of last resort. So they were a lender of last resort in the financial crisis of 2007, not so much during the Great Depression. There are things they could have done and did not. But Fed does issue currency, Federal Reserve notes. It sets reserve requirements for member banks. We'll see about that later. It can lend money to the banks, collect checks, even though we don't write checks much anymore. U.S. government has an account at the Fed, so the U.S. Treasury. And then the Federal Reserve also supervises member banks and can audit them. So it was established by Congress as an independent agency, which does protect it from political pressures. So this enables the Fed to be mostly nonpartisan. For example, President Jimmy Carter appointed Paul Volcker, I believe, to be Fed chair. Reagan, who became president, Republican right after that, kept him on. And most presidents will keep the Fed chair in place no matter who appointed them until they retire, and then they'll appoint someone else. But they appear to be pretty much above politics. And they're not running for election. They are appointed with Senate approval. So what happened in our Great Recession? Mortgage default crisis, many causes. Important definition, even though it's not in your book. Government programs that encouraged home ownership. One of these was Fannie Mae, the Federal National Mortgage Association, FNMA. And it was created during FDR's New Deal in the 30s to encourage home ownership. And there's certainly nothing wrong with that. But what happened is that you kind of get the banks off the hook for those loans, because these government-sponsored enterprises, GSEs, would buy mortgages from the banks, give the banks more money to lend. Then they would bundle those, the government would bundle those and sell them as a bond to investors. And there were some bad incentives provided by those. And this is important definition: securitization, process of slicing up and bundling groups of loans into new securities. So the Fannie Mae bought, and others as well, not just Fannie Mae, it's just one of the biggest ones. But they bought loans from banks, bundled them into new securities, and sold those to investors. So all's good as long as everybody's paying their mortgage. But what happens when they're not? And 2007, this started to happen in a big way. It had been too easy to get a loan. So we saw some failures. The two largest home loan lenders, Washington Mutual and Countrywide, went bankrupt. Other firms came close. So the government passed the TARP, Troubled Asset Relief Program, in 2007 or 8, which allocated $700 billion. Emergency loans did save some institutions from failure. Some did fail. Lehman Brothers was the fourth largest investment bank in the country, and it failed. It was allowed to fail. But when we look at, we'll skip over this to more specific, looking on your right over there at the examples, these are all institutions that were holding some of those securities. You know, you may not have held a security, one of those bonds, but you probably have a bank account somewhere, and your bank would have been affected by it. So all of these on the left, Fidelity, TIAA-CREF, the teachers' pension funds, I had some of these bonds, so they were tied to the taxpayer. So taxpayer bailed out some of these companies, and most of the money was paid back, which is a good thing, but it was a huge, huge bailout. And if those mortgage-backed securities hadn't existed, it may not have had to happen. Canada, for example, never had a program like this, which started again in the U.S. in the 30s, and really wasn't much of a problem until those loans started to go south. But in the 1990s, those Fannie Mae and Freddie Mac started buying what we call subprime mortgages. Important test question. Subprime mortgage are high-risk mortgages to customers who have a not very good credit rating. So they shouldn't have been given loans, and we ended up with a huge problem with that and a taxpayer bailout. But that was a promise by the government that all of these institutions on the right would have capital to get by. So after the crisis, Wall Street Reform and Consumer Protection Act, which is known as Dodd-Frank, passed, was supposed to help many of the practices that led to the crisis, but there are many critics of it that say it added too many regulatory costs to banks, because all banks weren't guilty of some of these practices, but they still had to pay the price and have more regulations put on them. But the important thing is the Fed had to act as a lender of last resort for both the solvent and insolvent firms, which increases the moral hazard. When you know you're going to get bailed out, what's the incentive to be careful in the future where loans are going? So, again, some important definitions out of this chapter. Fannie Mae, Federal National Mortgage Association, government-sponsored enterprises, TARP, Troubled Asset Relief Program, subprime mortgages, mortgage-backed securities, Federal Reserve, chair is Jerome Powell, the makeup of the Fed. All of those are important out of this particular chapter.